How are advisors using factor-based building blocks in global multi-asset portfolios that dynamically shift as markets evolve? Hi, I'm Travis Robinson and I work within our financial advisor channel at S&P Dow Jones Indices. Here with me to discuss implementing factor strategies is Sean Commerstadt, President and Portfolio Manager at Two Rivers Capital in Denver, Colorado. Hi Sean, thank you for joining me today here in New York.
I appreciate it, great to be here.
So let's just jump right into it. You're the portfolio manager on a global equity portfolio and you use factors. Can you tell us a bit more what that looks like?
Sure, absolutely. So our flagship strategy is a custom index, and we look at the globe and factors through kind of a two-step process. Number one, we isolate the single strongest factor within each major global region, so emerging markets, US, international, developed, and the specific factors that we use are low volatility, high beta, momentum. So we'll determine using price momentum what the single strongest position within each of those three regions is, and then we'll pit those against each other to define the single strongest region and the single strongest factor within that region. So when we first designed the model, what we saw was, there's consistent, exceptionally wide dispersion in returns between all these factors. So it lends itself perfectly to a tactical approach like ours. So yes, we simply view that lens via price momentum to get us in the strength and avoid the weakness over time. So
okay, and there are hundreds of factors out there, and most notable are value or quality. So why low vol, high beta, and momentum specifically? Just those three?
Sure. So back when, to my previous point a little bit, back when the methodology was first developed, we actually used the algorithm and the style over style and size box ETFs. So what we saw when looking at it through that prism was even large value versus large growth, et cetera, in all the different global regions, that provided consistent wide dispersion in return. But then when factor ETFs came about, it gave us just a completely new tool set. And what happened is when we overlaid low volatility, momentum, high beta, et cetera, in that same opportunity set, the dispersions became even wider. So at the end of the day, the light bulb really went off at that point to say, okay, we can take the same momentum approach applied to factor ETFs, and it just increased the opportunity set incredibly. So it was we were really excited, and obviously the whole factor movement made our strategy better over time. So
okay, so it's momentum for low vol, momentum for momentum,
right?
That you're looking at,
right?
Okay, and so have you ever isolated one of those factors, say momentum, and looked at it's got to be different between the U.S. and international and even EM, and what does that look like when you analyze it across geographies?
Yeah, no, that's a great question. I think it's important when you're using a momentum approach. There's a lot of different triggers in terms of why and when people make moves into in and out of different asset classes. And what we saw in our work that was the crucial element to it all was being able to optimize the moving average combinations and the momentum combinations at both the factor level as well as the global level. Because when you look at for example, U.S. we look at low volatility versus momentum versus the straight index. Those trends tend to change at a relatively a faster pace than say just looking at the entire U.S. market versus emerging markets. So because the factor level changes at a different pace than the global level, it's important to have your momentum approach, optimized at both those levels instead of say using a blunt 50-day or 200-day moving average across the board and just calling it a day. So that's really kind of the vital component, being able to do it at both levels.
Okay, and so your strategy has been turned into an index, which means it's rules-based and pretty unemotional, right? So why go that route of unemotional? And I'm sure that's been hard at times to stick to. So can you talk a bit about that?
Yeah, well, I think the most important aspect of it all is having a custom index that is 100% rules-based. Keeps us from acting on gut instinct, right? Because at major inflection points in the market where asset classes are taking major turns, the emotional pull to want to override your system or change your investment process can be pretty strong. Yeah. So we know the rules work over time. Certainly Nothing works all the time, as with any strategy, but we know if held long enough, we're confident in our rule set. So that's the biggest thing. Yep. Ridding the whole process of any manager intuition or gut instinct.
Okay.
Secondly, I think the consistency and repeatability of the investment process. So when we have a custom index, clients know that our investment process is going to be the same, month after month after month. They don't have to worry about us waking up one day and deciding we want to change our investment approach because something changed in the market. And the investment process is kind of a moving target if you go down that hole. So it keeps us on point, and the repeatability of the investment process is absolutely huge. So.
And how are you accessing these factors?
So we happen to use a lot of the PowerShare suite. That happened to be the kind of the lineup that we were most comfortable with. They have a very robust lineup, and we happen to really like the types of exposure that it provided us to low vol, to momentum, because obviously there's a few approaches out there in terms of how exactly to access that. So that's what we were most comfortable with, and that's how we kind of developed the methodology around a lot of the indexes that track those those S&P indexes.
So you started with their suite, really? So.
We started with their suite from day one. Yep. Absolutely.
So one last question for you. Many ETF strategists today consider themselves tactical. We see a lot of that. What differentiates Two Rivers in your strategy from the rest?
Sure. Well, tactical can mean, as you know, a lot of different things, right? There's a lot of different approaches, a lot of different triggers for jumping in and out of asset classes. I think the easiest way to describe our strategy is we're not looking to trade all the time, right? We're not looking to trade every 5% move in the market, and we're not trying to avoid just regular expected market volatility, because that's just the cost of being in the markets. So on average, we have about 3 to 4 trades per year. So our goal is really to keep clients invested, but also one of the ways we differentiate ourselves is, there are times when you go through periods like '08, right, when those downturns that clients just can't afford to stomach. There's got to be some sort of sell discipline in place. So we do have a cash call that is, again, all rules based in terms of when it calls us to go out and when it calls us to get back in. That we employ during those, catastrophic, down markets. So that's another big thing. So, but it's, like anything, like you said, it can be tough to stick to any investment process if you're in it long enough. We basically faithfully follow the rules as hard as it might be. So.
Yeah. So keep it unemotional.
That's right.
Gotcha.
That's right.
Well, I want to thank you for your time and insights today.
Thank you. Thanks for having me.
For more information on how indexing works for advisors and to view the latest factor dashboard from S&P, visit spdji.com. Thank you for joining us today.